Welcome to the latest edition of the Tax Hour podcast. Today, I'm delighted to be joined by Emma Chamberlain, who is a practicing barrister and visiting professor of law at Oxford University and the LSE. And today we are, I think, debating, that's not the right word. We're discussing one of the most hotly debated topics, I think, in recent times, a wealth tax. So thank you for joining me, Emma. I thought we'll start with a couple of warm-up questions just to get us in the groove of it and sort of understand a bit about what the topic is, and then we'll go into more of the detail. So before we get into that detail, can you take us back to April 2020? You were one of the three commissioners for a wealth tax commission. What was going on at the time? What was the fiscal outlook looking quite bad at the time because for obvious reasons? And what motivated the commission to be established?
I think it was a bit happenstance. Originally, I was only just going to write a chapter on design of wealth taxes for the Wealth Tax Commission, which didn't have a name then. Yeah. And I think one of the purposes of this academic work, because it was really academics as much as practitioners, although we did bring in quite a lot of practitioners as well, was to really examine the pros and cons of a wealth tax. And there is lots of, whenever there's a crisis fiscally or people are cross about the government, they always talk about a wealth tax. And so the aim was really just to have a look at it without any, and I really didn't have any preconceived ideas of whether it was a good thing or a bad thing. I was interested to sort of find out more about it and what happens in different countries and, why doesn't it work better, etc. So we were really looking at it sort of quite from scratch. We got lots of people to do different pieces of work. So each chapter, had an economist looking at certain aspects. We had valuation, administration, liquidity. I did the design of taxes. So there were a whole host of different experts, and behind it, and you can see all of them on the website even now. And behind that, you can also get sort of further papers which look at specific countries. And so it was partly, genuinely academic. It was an academic body of work for other people to use in the future. And we also sort of got quite a lot of historic papers, the Green Paper when Denis Healey was talking about introducing a wealth tax, because he was elected on that manifesto, actually. That was 1974. Yeah, he was elected on a manifesto of capital transfer tax and wealth tax. He managed capital transfer tax, but he didn't succeed in a wealth tax, which does tell you something about how to get change in our system. And Ireland also had a similar thing in the 70s, capital acquisitions tax, and they did implement a wealth tax, but eventually abandoned it. So all of that, those records and reports, and we even went back to Lloyd George and the land value tax, which has actually been discussed quite a lot now. So we just thought it would be useful to have that in the public domain, because it was actually quite hard to get together, because obviously there wasn't internet around then. We had to dig it all out. So that's sort of where it started. And originally I was only going to do one chapter, and I sort of got more interested in it and did more. And in the end, we sort of did the final report, which was a sort of summary and recommendations, and then sort of one-off questions together. Not always with agreement, in fact, very far from agreement, but we were able to agree on certain, large relevant principles.
I think that's interesting that even between you, you're not necessarily in agreement on every aspect, because, and I, obviously being a tax person, I'm thinking about the tax, but the more I've sort of been, when I've been preparing for this podcast, the more I've thought this is less about tax, more economics and things like that, and the public perception and what the response would be to things like this. So the tax is a very small part of this, really, isn't it?
Well, I think you've got to work out what the design of the tax is, and I think one of the problems why Healey failed, there are a number of reasons why it failed, but they hadn't really thought in detail about the design of the tax. Right. And so, in fact, I think Healey says in his autobiography, whatever I did, I just had to keep introducing new exemptions, which made the whole thing not worthwhile. And of course, that does tend to be what happens when you don't think about things. I think we weren't always in agreement on sort of all aspects, but I think what we were in agreement was that if you were going to have a wealth tax, and we actually didn't recommend an annual wealth tax at all in the end, but if you were going to have one, you had to have it on everything. We probably came to that conclusion for different reasons. I mean, I think economists would say you can't have an exemption because then everyone piles into the exemption. And it's also quite unfair. So if you exempt the main house, which many people felt very strongly that we were proposing that the main house shouldn't be exempted, then why would you say that someone who was lucky enough to own their own house should not be subject to a wealth tax, but someone who was paying to save for a house should be? And there are those issues. And then I think one of the reasons why nobody liked the report when it came out was that we actually didn't offer any exemptions. So every possible interest group was against us. So people who had houses didn't like it, and people who had businesses didn't like it, and people who had high pension wealth, which are the sort of three main areas of wealth in the UK, they certainly didn't like it. And we had all sorts of arguments about how you can't value pensions, which is obviously nonsense because we value them all the time in areas like divorce. But anyway, I think that was sort of, we were united on that. I think we were united also that having an annual wealth tax was not really feasible and not desirable either. And we weren't, everyone thought we were recommending a one-off wealth tax. We did not recommend a one-off wealth tax. What we said is if you need to raise money, and obviously there was an issue with COVID about raising a lot of money because it was costing a lot of money. And remember, we didn't publish our report until December 2020, where the extent of the debt was only just becoming apparent. If you were going to raise taxes, this would be one way of doing so, which would be less economically destructive than raising income tax or national insurance or corporation tax. Yeah. Obviously, the government didn't take any notice of that. I think also the other reason why people were not very interested in a one-off wealth tax to deal with the sort of crisis of COVID, and I think no one can deny that it was an extraordinary event, was that borrowing was really cheap. So I remember going in front of the Treasury Select Committee and nobody was interested in a wealth tax at all, or one-off wealth tax to raise money, because everybody said, well, you can borrow really cheaply. Why should we want to tax people? And that, of course, changed quite rapidly. So I think we made perhaps some mistakes. One was having it on everything, which I still think is the right thing. One was calling it a wealth tax. I mean, you could have called it a COVID recovery tax or something like that.
I think that might have been, because I also watched because the wealth tax, I should say also, the Wealth Tax Commission's website has a huge amount of, if you're interested in this topic, you should definitely look at that. But in the, you did a webinar, didn't you, with the three commissioners? And that was actually mentioned that this is specifically really is a COVID recovery.
And that was the basis on which you could say it was one-off. And again, we didn't recommend it. I mean, government chose not to follow any of the recommendations. And we just said that if you do have to raise taxes, this is one way of doing it that might be less economically distortionary. I think all of that is really very out of date now, because I don't think there's any possibility of having either an annual or a one-off wealth tax, or at least I think it would be very unwise to do that. I think one of the problems of the one-off wealth tax is why would it be one-off when we don't really have any one-off conditions to make it
That was
justifiable.
actually one of my biggest questions, was because of this talk about the idea that having the wealth tax when the Commission did their report was about COVID.
Yeah.
Is it almost too late?
It's too late. And I think any government that wanted to, or any party that wanted to introduce a one-off wealth tax now would have to justify why it would be one-off, because I think even then people were saying, well, how do we know it's going to be one-off? I mean, what we were saying, just to be clear on a one-off wealth tax, is if you introduced it, and we did not, contrary to popular opinion, we didn't say do it at 500,000 or a threshold of 1 million of wealth. We said if you take all your wealth, your houses, businesses, pensions, personal items, cash, savings, deduct any debt, and then you get to a threshold. At that point, you can levy a one-off wealth tax, which is payable over 5 years, but it's only one-off, and that's it. But if you wanted to do that now, I think you'd need a political sort of manifesto. You'd have to have credibility politically to do that. I don't think you could just sort of announce it having been voted into government, because there's nothing particularly exceptional about anything that's going on. It's been going on for ages. And I think that's a major problem, because, of course, that will lead to avoidance, etc.
Yeah, because I guess the problem is, if you say we're now going to do a wealth tax and you're successful, and one of the numbers, and I know you said you didn't recommend anything, but some of the examples used in the report with things like a £500,000 threshold could raise 260 billion. So if you were successful in implementing a wealth tax and raising that, everyone would surely be thinking, well, it worked last time, so give it 5 years, give it 10 years, we can go again, kind of thing.
Well, I think politicians might think that, unfortunately, and I think that's the difficulty with it, and that's why I don't. Countries can have wealth taxes, but I don't think in our particular system any wealth tax, never mind the economics of it, which I know people say you lose capital and it's not a good way of taxing people, and economics is above my pay grade, but in terms of tax design in our existing tax system, I think a wealth tax would be a seriously poor idea, without absolutely radical change on the whole of the capital taxes system. And the problem with that is that none of these taxes can raise a huge amount of money, because the number of wealthy people in this country is relatively small. So any change you do is very vulnerable to behavioural response. So if you're going to only have a tax, say a wealth tax, which I know some people suggest will wealth above 10 million, that's not a very few numbers, small number of individuals who can quite easily leave. And I mean, one of the advantages of a one-off wealth tax is we could sort of deal with people leaving, because we could say, well, if you've been in the UK for 4 out of the last 7 years, you're still taxed, even if you've already left. If you have an annual wealth tax, you can't really do that. So not only are you people who have left don't have to pay it, but also it stops people coming, and people never. It's not just about making people leave; it's also about stopping people coming if they think there's going to be an annual wealth tax, and that is a real problem.
Because I think that's kind of the thing I've always thought about, that raising taxes isn't the only way to raise money. And a focus has to be on growth and encouraging more investment into the UK.
Yeah, and I think one of the problems with the current budget being so late, and this sort of endless pitch rolling all the time of all these taxes that the government seem to want to be talking about, is it really discourages confidence. So people think, oh, I would quite like to come to the UK. They've got a 4-year exemption for people who've just arrived. No inheritance tax for 10 years. And then the next thing you hear is someone talks about a wealth tax. Well, they don't like that. And then you talking about an exit tax. And they think, crikey, if I come, I might not be able to leave. What they call a settling up tax, I noticed in the papers at the weekend. I mean, all of this is incredibly detrimental to get people to come here. It doesn't mean that people can't necessarily invest in this country, being non-resident, but you do also want people to come here and work here.
Now, we've kind of got into this, but one of the things I was actually going to start with is let's define a wealth tax. So let's. I think you've probably actually touched on this already.
Yeah, a wealth tax varies according to the countries that run it, but basically it's a tax on all the wealth you own. I don't think there's any country that taxes intellectual property, your own brain, your power, as it were, but any house, any business, any savings, your pension. All of that goes into the wealth tax net, and you deduct debt, and then you pay whatever percentage a government decides above a certain threshold. And broadly, countries mostly tax at quite high thresholds. So you don't pay wealth tax until you reach, let's say, 1 million or 3 million a household. Switzerland is the outlier on that. Their taxes are cantonal tax, so it's local, and it varies according to canton, but typically it will start at a very low base, but at a very low rate. So it will start maybe when you've got wealth of less than 500,000, but it will tax you at 0.01%. So, it's a very efficient system, but administratively much more complex. So you're really saying everybody every year pays some wealth tax, but it's a tiny amount. But what you're doing is increasing numbers. And one of the problems with a wealth tax with a high threshold is that the numbers are very small, and therefore they're very susceptible to behavioural change.
One of the reports I was reading was saying sort of there's 8 million, if you have a threshold at half a £1,000,000, there's 8 million individuals.
Yeah, that may be different, slightly different now, but yeah.
But if you increase it to, I think it was 2 million, that goes down to 600,000.
Yeah, and then, you get to 10 million and it's probably, 20,000 or something, and those people are much more, well, first of all, they can do things like leave. So over time, they might pay a one-off wealth tax, but as I say, I don't think that's politically feasible without a clear political manifesto commitment. But they're not going to be paying an annual wealth tax once they've left, or at least not for very long. And the other thing is that if you start having a high threshold, people can do much more avoidance. So they can split it. They can start giving it away to their children. Then we get into quite tricky design questions, which was the sort of thing I was thinking of was, well, do you tax per household or do you tax per individual? If you're an individual who gives away to your adult children, is it fair that your adult children's wealth should be included in yours? I think that would be very bizarre. If you give it to a spouse, is it fair that the spouse's wealth is included in yours? We've just had have independent taxation applying to some things, but we don't to the benefit system. So all of those questions are actually quite difficult to solve. And Switzerland, to some extent, manages to get around them because it is at a very low threshold. So there's no real incentive to start giving loads of money to your children, because if you're taxing at a low threshold, they're all going to pay the same amount anyway. But doing that low threshold does make it, much more administratively burdensome.
Yeah. So when we're talking about a wealth tax, we've got two options: an annual wealth tax or a one-off wealth tax.
Those are the only two I can think of at the moment. Yes, there are other options to taxing wealth, but those.
So how quickly did you discount? When obviously you were doing the report in 2020, how quickly did you discount the idea of an annual wealth tax? Was that quite an easy conclusion to reach?
Not at all. I think we got to September and all the chapters were coming in that people had contributed to, because I do stress this was an effort from lots and lots of people.
That's one thing I was actually going to say. The commission itself was one of, if not the biggest, certainly for 50 odd years. Actual work on this area.
And I don't think there is, I think it is useful as an academic body of research. So anyone who's looking at wealth taxes or capital taxes, it's really worth looking at the site just to get information, whatever your views, because that was part of the aim. It wasn't just about should we have a wealth tax or not. The aim was to gather up information. So you didn't get a politician saying what we need is a wealth tax and then everyone's saying, oh, well, hang on, where's the data? Because it's all there. And other countries have used that as well. So I think it was an academic exercise primarily. What was the question? You would say, oh, yes, we were going along and these chapters were coming in. And as they came in, I don't think we talked to each other particularly because obviously no one could meet. So it was all done on Zoom and we were all doing other things as well. I think we probably all thought separately, this doesn't look great. What was becoming apparent was that an annual wealth tax, no matter how you dealt with it, just had this problem that you needed to value assets every year, or you could value them every 5 years, but that had its own problems in manipulation. And you could never really get over that problem. So then would you have a sort of way of valuing assets which is just a formula rather than an actual open market value? Again, if you have a one-off wealth tax, an open market value is much easier because you can actually devote a bit of time to it. If you're on an annual tax, you can't have a situation where you're 5 years behind on a valuation because you still haven't agreed it in 2030. And then in the meantime, another 5 years has gone by and you've got to value it all over again. That's one of the real problems on an annual wealth tax. And some things are very easy to value, but lots of things aren't actually. And lots of things that are owned by wealthier people aren't easy to value. So that was one problem we could never quite get over. There were also on an annual wealth tax significantly greater liquidity problems, I think, for business and groups like farmers. And farmers, obviously, we've seen with the inheritance tax changes, there is a real liquidity problem there. And obviously, the problem with an annual wealth tax, it's happening every year. And so you just get into greater and greater liquidity problems, and then you're having to sell your capital. And this is all terrible for business. So I don't think we actually spoke to each other about it until we had a sort of online seminar with everybody speaking, everyone doing a slot who'd contributed to the papers. Right. And then I think we sort of realised that probably it wasn't a great idea. And then I think we all came separately to the view that if you were going to do anything on wealth tax, and we didn't necessarily think you should, but maybe a one-off wealth tax was a preferable idea. And the design aspects and the valuation, the liquidity aspects would be easier. And you could sort of basically, even if people had left, you could say, well, you were here for the 4 out of the last 7 years, so you've got to pay something. And for people who came, they wouldn't be subject to it because they hadn't been in the UK. So there were sort of principled advantages of it. But we weren't, as I say, we just said if you're going to raise taxes, this is one thing you could look at. No party did look at it. So from that perspective, it was a waste of time. But from the perspective of a body of academic research that people can use in the future.
I was going to say, I think this will be something that is regularly looked back at.
And I don't think obviously there have been changes and different countries have done different things, but I don't think fundamentally how we tackled it is out of date. I think it is a useful piece of research.
Yeah, well, we mentioned the fact that it was Denis Healey in 1974 that was really the last proper. So you could argue, well, an awful lot has changed in those 50 years in terms of, just how we do business. We didn't have the internet then, did we?
No, not in 1974, not to my knowledge.
So, so much has changed with sort of how global mobility and all of this type of thing that it makes sense that we would need sort of to actually have something like the Wealth Tax Commission's report to actually understand wealth taxes now in this current sort of generation, if you like.
Yeah, we didn't look in great detail about the other taxes we have on wealth in this country. We did look to some extent about why they're dysfunctional. And I think one of the responses, which I think is completely legitimate, is that we already have quite a dysfunctional tax system on taxing wealth in this country. Why add to it with yet another tax? And Switzerland is often cited as a country that does have quite a successful wealth tax. But it's a very different model. It's it's cantonally based. People do move between cantons to get to lower wealth tax. So Geneva, for example, is much higher, say, than Zurich. But also they don't generally have capital gains tax. So in a way, their wealth tax is sort of doing duty as a tax on unrealised gains. That's how it operates in a way. And they don't have generally inheritance tax. There are some cantons that tax wealth if you leave it outside your children. But it's still not that usual. And so their tax system, it doesn't have two major taxes that we do have on capital. They don't have that. And their wealth tax is sort of aiming to do something different. So I think one has to be quite careful on country comparisons. For example, Norway doesn't have inheritance tax, but it does have a wealth tax. I think people are always comparing the UK system with other countries, but often the comparisons aren't very
it's almost
fair.
Not possible, is it?
Yeah, well, every country does things slightly differently. On capital, there's much more similarity on how we tax PAYE, earned income, but much less on how we tax capital.
Yeah, because I don't think I necessarily thought we'd talk too much about this, but I think maybe it is worth us chatting about the idea of actually, should we actually think more about a reform of, I'm not going to call it the general broad spectrum wealth.
Tax.
Because I mean, one report that I read before the last autumn budget in 2024 was the IFS's report on capital gains tax, where they made several recommendations about how we could reform CGT for the better. And so I guess linking that back to wealth taxes, would we be better off, rather than talking about should we have an annual, should we have a one-off wealth tax, would we be better saying, actually, let's have a look at CGT, IHT, all of the wealth taxes in the round, and consider a complete reform in that overall?
I certainly think that would be a better way to go. The problem is that losers always shout louder than winners, and I certainly think it's worth looking at taxes like inheritance tax in a more holistic way. I think trying to do anything else is bound to cause a lot of problems for any government. So, for example, the changes to pensions. So now announced from April 27, there will be tax on pensions, on death benefits, pension funds on death, which actually not many people objected to as a matter of principle. But the way it's been implemented, because basically the current recommendation, the latest consultation on legislation produced by the government, is that if you have a pension fund, the tax on that pension fund is going to be borne by the free estate, your non-pension assets, which sounds fine until you think, well, actually, maybe the pension is going to someone completely different, and the free estate, the pension may be going to the children, and the free estate may be going to the cohabitee. Then you've immediately got problems, because one of them is going to be quite unfairly treated. They are effectively bearing the burden of inheritance tax. Although there are ways of trying to recoup that, they're not easy. And I think that's where an example of better design would result in a better outcome. And I think looking at it in that sort of more holistic way, and being aware of all the vagaries of pensions as well, would help. I mean, the whole pension system is massively overcomplicated, because every government has fiddled with it. And when you think about it, it's a really bizarre thing that we all start saving for pensions from about 25, and no one knows what the tax system is going to be when we come to retire. And even if you have retired, it's now changed. And I don't think that's a very sensible way of running something that really is meant to be a long-term investment. So I think anything you can get to have more political consensus between parties is also helpful, because there's no point in saying you're going to have tax on, I mean, capital transfer tax is a case in point. Healey said, well, I'm going to have tax on lifetime gifts. Well, the Tories didn't commit to that, and everyone knew they only had to wait, and the Tories would get voted back in, and before you knew it, you wouldn't have tax on lifetime gifts, which indeed is what happened in 1986. So I don't think capital taxes can really be reformed without a lot more political consensus, and that really means thinking about the principles on which you want to tax wealth. Yeah. Is it just about reducing wealth inequality, or is it about raising revenue? And I think people, there are inheritance tax is quite a dysfunctional tax in many ways. They've just changed the rules on business property relief with effect from April 26, and agricultural property relief. They're not going to raise that much money from it. So it clearly wasn't about raising huge amounts of money, but it was about some notion of fairness. But the way they've done it has introduced yet another level of complexity and potential unfairness. And, just looking at inheritance tax, is it fair that you could, for example, give away cash to your children and survive 7 years and not have to pay inheritance tax? But if your main wealth is tied up in your house, you can't give it away. But then equally, is it fair that you should get a residential nil rate band on your death if you've got children, but you don't get something if you don't have children? I mean, the whole thing just needs looking at properly, rather than just introducing a little relief here or a restriction there.
But so I mentioned the IFS report, and obviously
that was focused on, that also looked at BPR actually, and that was
Yeah.
sort of a bit of a sweet basket of, oh, well, let's do this, and I would step back and look at it in a more holistic way.
That was kind of going to be my question, is actually who should be doing this? It feels like almost like what the Wealth Tax Commission did for wealth taxes.
Yeah.
We need.
Well, there may be another piece of work that could be done on that. I mean, there's no real incentive, though, for governments to do it, because whatever way you swing that particular cat, as it were, you can't raise that much money from wealth taxes, short of very high rates, which will be very disadvantageous. What are we actually trying to achieve with these capital taxes? And that probably does require some sort of body, but I'm always reluctant to say have another body on tax. But it may require something like a body of academic research, which can then inform governments to a higher level.
I think that's really interesting, because I think so much is always, which Rachel Reeves did a speech this week, didn't she, about sort of what is clearly sort of very likely to lead to some changes in the budget. But I actually, what she was saying actually did resonate with me, in terms of we can't just, and I think you've kind of alluded to the same point, that we can't just tweak things around the edges and expect, eventually you end up in a system where the whole thing needs a bit of.
It's just a dysfunctional system, because no government wants to say they're going to raise income tax, so they introduce lots of other complexities into the system, which make it even more dysfunctional. And I think Dan Needle's often talked about this very bizarre business of having a 60% rate between 100 and 125,000. And these are the sorts of things that people do when they're trying to disguise the fact that really they're raising tax rates. And maybe, I agree with Rachel Reeves to the extent that we do need a more honest conversation about it, and people need to sort of just accept certain things. And I think people can't keep sort of hiding and saying, oh, well, the wealthy, the very wealthy can pay it, because there just aren't enough of them in this country to pay to cover the shortfall.
And then there's, as you've already said, if you implement a system like that that's deemed to be unfair, they'll just leave.
Yeah. I mean, I think it's exaggerated how mobile people are. But if you're a wealth tax that is a very high level of wealth, that affects relatively few individuals, and they will tend to leave. I mean, I don't think that means we can't tax wealthy people, by the way. I think we could have better systems to tax them. I think part of the problem is that our system is far too complicated, and we might have to sacrifice simplicity. We might have to sacrifice a little bit of fairness for greater simplicity. I mean, actually, in Switzerland, wealthy people do pay quite a lot of tax. And it's interesting to understand why they're prepared to pay that. And part of the reason is because it's a much simpler system. Right. And there are not all these taxes coming in from different angles to hit you. And, you don't have to go and see an expensive tax barrister to work out whether you bought your house in the right way. These are easier issues.
I think I was reading, one of the articles I was reading in preparation for this was actually talking about the different taxes on that. So it was talking about CGT, IHT, then we've got council tax, SDLT. And so you do kind of think there's an awful lot.
Yeah, I mean, property taxes as a package are high in this country. And people have been talking about having higher levels of council tax, which, seems to be a move that the government may make. I mean, I just point out that unlike the wealth tax, which did take into account debt, council tax doesn't. Yeah. So, if you're a person who's just bought a £3 million house in London with a load of debt, you will, and they have a council tax increase, potentially you are quite adversely affected. You'll have paid a load of stamp duty. You've probably got a very high mortgage. You must be quite a high earner, so quite a lot's coming out on that. And I think you have to, just saying, oh, well, I'm going to tax all houses over 3 million may be quite unfair, actually. Yeah. Because people on that, someone buying a £3 million house in London, might, or £2 million house might think, well, crikey, I can't afford that increased council tax. I hadn't done my calculations on that basis. But I think that's why it's never that simple to introduce those sorts of changes into the system, and then people get very resentful.
I think that's the problem. So in your example, they bought their £3 million house, maybe they've got a £2 million mortgage on it, and then
they're probably
the
paying
budget
for
happens.
childcare.
Yeah,
They're probably got tax, and they've got a high salary because they're living in London.
exactly. But then the budget happens, and all of a sudden it's gone from our outgoings are X a month
to a higher amount.
Yeah,
and that has an effect on people.
Yeah, and hence the unfairness, and I think this is where it
and the resentment.
Yeah. And I think that's almost to me, that seems like the bigger challenge, because it's more of an uncertainty. So we may be able to design something that appears to be very beneficial and efficient as a tax, but if the public perceives it in the wrong way, or if it's sold to the public in the wrong way, then it almost fails before it starts.
I mean, council tax was never intended as a long-term proposition. It's just that no governments ever wanted to go anywhere near it after poll tax. And I mean, it's a very unprogressive tax, and the valuations going back to 91 are clearly mad. I think Wales did have a revaluation in the 2000s, but the UK hasn't. I mean, England hasn't. You could start with that as just get the valuations right.
So we've kind of gone completely off script, which is kind of what I like, to be honest. It's getting the interesting topics out there, but regardless of what I thought might be worth talking about. But at that point, shall we talk about one of the points I was actually going to talk about in terms of wealth taxes, which was around fairness and horizontal fairness, vertical fairness. Can you explain a bit more about what these terms mean?
I think the idea on horizontal equity is that, and equity generally, is that you don't want people who have different types of assets to be taxed very differently. And most countries with a wealth tax do that, actually. If you've got a business, it's exempt. And we do that on all sorts of assets in inheritance tax.
Yeah. Well, business property relief does that.
Yeah. And I mean, the question is it right that a business that's 51% trading and 49% investment gets, at the moment, 100% relief, but one with 51% investment and 49% trading doesn't get any relief, which is sort of where you are. So I think that was sort of one aspect. But I think what we felt was that people of similar means should end up with the same tax bill, regardless of the form in which they chose to hold their wealth. So someone who puts their wealth into pension shouldn't be taxed less than someone who holds their wealth in a business. After all, lots of businesses use their own business as a pension. That's what they're planning to sell, live off the proceeds. Why should they have to pay a wealth tax? And people who might have a very good pension don't have to pay a wealth tax. So that was one reason why we wanted to tax everybody, that it should avoid incentivizing people to go into one form of wealth rather than another. And I think also there was sort of vertical fairness. If you have exemptions, it distorts how progressive the tax is in practice. And I think France experienced this because they had lots of exemptions for certain types of wealth, and then the whole thing got undermined. So France's wealth tax eventually got narrowed down to effectively a property tax. And that is where it is now. And obviously the other thing is that if you have exemptions, you reduce revenue. I mean, if you take out pensions, you massively reduce your revenue. And you encourage avoidance. And even under a one-off wealth tax, we felt giving an exemption would encourage some form of avoidance. So that's why we wanted to tax all wealth, but that made us very unpopular. So I don't think any government would follow that route.
So just talking about what the Wealth Tax Commission actually did suggest were things like because inherently you have a dry tax charge, but the fact that you could then maybe pay it over a five-year period.
It was 5 years, yeah, that's what we suggested. With slightly longer if you had liquidity issues, and obviously you wouldn't have to pay it on your pension fund, until you drew it down. So,
Because if you just take someone who maybe isn't a business owner or might not have various forms of wealth, if we just take someone who maybe has a decent sized family home, which is therefore valuable, and a decent pension, they've got arguably no liquidity at all. But could we not just say, well, but you have cash, it's in the pension?
well, I mean, there's a lot of stuff about this, and there is actually a liquidity chapter. First of all, we're not taxing the total value of the house, we're taxing the net value of the house. So if you've got a house that's worth 5 million and a mortgage of 4.5, you've actually only got wealth of 500,000 and a pension, and you probably aren't going to be within a one-off wealth tax anyway, assuming it's at a relatively high threshold. When we looked at the liquidity issues, the only people who were really affected by liquidity were farmers, because basically people don't generally have very, very valuable houses free of mortgage and absolutely no resources to pay it. But if they did, there was a sort of thing that we had to, a relief to enable them. I think it was something like if the wealth tax is more than 10% of their income, something like that. And then there would be measures in place. But I think it's funny looking at it from 5 years on, you think this all seems really quite theoretical now. It just doesn't seem at all likely. And I think it just demonstrates how devastating COVID was and how people felt about it, that we produced this report because we could have produced a report and said, don't do anything, leave it alone. We've done all these reports, and we shouldn't go near wealth tax. That might have been the result now.
Yeah. Where shall we go to next? I am quite conscious of time. In terms of the avoidance and the evasion, just to touch on that briefly, or perhaps round up, because I think we have kind of touched on it throughout, haven't we?
Yeah. The higher the threshold, certainly on an annual wealth tax, the easier the avoidance. You split your wealth, you fragment it, you can have trusts, you can give it away to your children, you can have minority shareholdings, all the stuff that people do anyway on inheritance tax. Yeah, sure, you can have anti-avoidance rules and related property rules, which we have for IHT, but none of them are foolproof, and you're increasing the valuation problems. And that is a major problem about an annual wealth tax. I mean, if you're saying, okay, well, someone gives away 50% of their company, and now they own less than a controlling shareholding, and now I've got to value that controlling shareholding, and meanwhile their children have got these minority interests. So how do we value that? These aren't theoretical problems; they are real problems. They may not be economic problems, but they are really problems that we do have to worry about, because it's a lot of taxes and tax changes fail because of the design, and the implementation is just not practical. I think on a one-off wealth tax, it's harder to avoid if you just announce it. But as I've said, I think if you just announce it, what's your political mandate for that?
Yeah, which then leads to, as we've already said, if you do just announce it and it's successful, are people really going to believe it's a one-off and everything else? So just talking briefly about implementation then, if you do want to implement something like this, or indeed if you want to implement a much broader reform of everything, CGT, IHT, wealth, what sort of time period do we actually need for that? It's not going to be an overnight thing, is it?
No, but you are still collecting some taxes from wealth, and you probably, I think you do need something that is not necessarily like the Office for Tax Simplification. You might need another body of work on looking at these taxes, and really doing some proper comparisons with other countries on how you're going to do it. And the interaction of these different taxes will probably be much more complex in a way than wealth tax. And work, does get done on that. Yeah. And we have better data on the wealthy than we used to have, although still far from perfect, because obviously there's more data on what people own, properties, etc. Yeah.
And it's easier to collect that as well, isn't it? Like land registry.
Yeah, and but if the land registry owns through an offshore company, now land is owned. There's a lot more data on providing that information, but I don't think it's easy. And I mean, you could take a shortcut and just say, I'm just going to have very simple, flat taxes on wealth, which are really low. 10%. Yeah, or maybe you don't. I mean, a lot of countries don't bother with inheritance tax and wealth taxes, and even capital gains tax. They just go for a different model entirely. I mean, Sweden abandoned wealth taxes, inheritance tax. So quite a lot of their capital taxes. So they've gone for a completely different model. And you could say, well, should we consider that? And that may be a piece of work worth doing. What I think isn't helpful is the government continually fiddles around with these things, and we just make it even worse and make people even crosser. But the non-dom stuff, there were lots of simplifications there which were positive. I know people have complained about it, but they've probably complained about it because certain aspects of it are still not right. But the fundamental of not taxing people by reference to their domicile probably was a good, I think personally was the right move.
Thought we'll end on a bit of a quick fire questions round. Before I do, there's a couple of things I did want to kind of highlight, which I've already said once, but just to repeat, the Wealth Tax Commission website has a huge amount of information on there. All of the reports.
Yeah. You just have to dig around the evidence papers behind the chapters.
So anybody looking to actually understand this in greater detail, there's webinars on there as well. So that's a really good source of information. And also something I'm signed up for is it on the 1st of December you're talking to Andy and Aaron?
Yes, in fact, it's a good point. It is the 1st of December, is it?
I think it is.
I think it's down at the LSC in the old hall, and there are tickets. You can buy tickets, so it's in the LSC in person. I'm not sure if it's being broadcast.
It is online because that's the one I'm signed up for.
Oh, is it? Okay.
So it's online.
So you can go in person or online.
Yeah.
This is me not reading it carefully, but yeah, we're talking sort of 5 years on, so I definitely look 5 years older.
So that will be something that I think, again, is going to be a really interesting conversation. So definitely look at that as well. Should we just do some quick fire questions? I think we've probably covered this. Will a wealth tax be introduced in the budget or within the next 12 months?
No, not in my view.
Should one be introduced?
No.
Should we reform?
Yeah, but taking a proper, longer time with political consensus. We have to get all the parties to agree on this.
If you could only tax one category of wealth, what would it be?
I wouldn't tax only one category of wealth.
Good answer. If a wealth tax was introduced, what do you think the ideal threshold would be?
I don't think. What you mean, a one-off or an annual?
Yeah. So if we're talking the one-off that was suggested, 500k, 2 million, much higher.
I would do it higher.
Switzerland's wealth tax works. France's failed. What's the key difference?
France, much more complicated system. They got inheritance tax, capital gains tax. They had lots more exemptions, and the threshold was higher.
So it's about fairness and understanding.
Yeah, and Switzerland's local. Everyone knows everyone else, and it's easier in that way to enforce.
Right. And finally, should the UK's goal be raising revenue from the wealthy or actively reducing wealth concentration?
In my view, raising revenue.
Excellent. Well, I think that's been a fascinating conversation. I completely went off script, but that's what I like to do because I think it's far more interesting to get kind of your perception of these things. So thank you so much for joining us.
No problem. Nice to be here.
We'll
thank you for asking me.
Thank you. And we'll put those links to the LSE conversation on the 1st of December. I'm saying 1st of December twice now. It better be the 1st of December.
Yeah.
But we'll put the links
5th, on. But maybe it's the 1st.
Otherwise, thank you very much for joining me, and hopefully we'll see everyone on the next one.